Okay, just to give you a little bit of my background, I started as a computer scientist. I started learning programming, computer science, building networks, and that really excited me because up to the point there that I even made my small home network and connected into the internet. That was almost 20 years ago, back when people were using their modems and telephone lines to access network. So internet, so the computer ran and the high-speed network was quite convenient back then. But then once I built that, I decided I don't want to work as a programmer for a living, and I went into finance. I started trading equities, equity derivatives, started understanding how the markets work, how they evolve, how they value assets, how capital is being raised, how capital is being deployed within those companies, and how that influences asset prices. That really excited me and continues to fascinate me up to these days. And then after the global financial crisis, I was searching for some asset that could shield from the volatility of the money supply and the excessive monetary policies and the central bank actions that were introduced back then. And Bitcoin naturally caught my eye. It took a while for me to understand the concept, but my computer background definitely helped. My networking background definitely helped. And then the understanding of financial assets, trading, markets really helped for me to understand the potential of this phenomenon, if I might. So what is really blockchain about? I wanted to have very kind of narrow thought for you guys here, so you can kind of visualize yourselves the potential of this technology. We have in finance three services that are called clearing, settlement, and custody, and they are the ones that are being disrupted by blockchain, and I'll explain why. So clearing is something when you check if another party you are going to transact with has some assets, has some funds. So when you meet in school or in university and you trade, say, I don't know, a pen or Magic the Gathering card or whatever you want to trade with your friend, you see it in his physical hand, right? You see, okay, here is this pen, here is this cash, and then you understand that this transaction can happen and the party has the asset. Now, over the network, over internet, or say in financial world, you cannot check that other party has particular asset. And there are intermediaries who facilitate that, obviously the banks. So when you want to do some particular transactions, you approach your bank and your bank gives you a statement, account statement that you have some funds. With this statement, you can come to another party who is selling an asset and then say, look, I have this cash or I have this stock and I'm willing to transact with you. It sounds simple, but it's really complicated when it comes to replicate this service in a trustless environment where there is no bank required, no broker required, and blockchain helps that. Second service is settlement, because once you know a party has some particular asset you want to transact with, and once you agree on the terms, you need to settle this transaction, right? In real life, you just give cash to a counterparty, and that's where settlement takes place. In our financial system, you send a money transfer through the banking system, and then the network, the banking network, SEPA network, or SWIFT network settles this transaction. Now, blockchain offers seamless and trustless settlement between counterparties, and that's very important. And basically found a lot of applications in decentralized finance we will be talking about later. And finally, custody. Again, in the cash example, you just store it in your pocket, right, or your wallet, and you custody your funds yourself. If you store some bigger amounts of stocks, or stocks are now all paperless, right? They're stored in digital custodies, or cash you store in Bank of Malta account or HSBC or whatever bank you use, or Revolut. It's also a custody of your asset. and this is a centralized custody. So if something happens with the balance sheet of that entity, your money could disappear. In order to protect citizens, governments introduced what's called deposit insurance scheme, where everybody in the European Union is insured up to 100,000 euro worth of deposits across his accounts. But that doesn't remove the problem, right? So somebody still has to custody your assets, has to be responsible for that, has to get licensed to do it, has to insure it, and then incur a lot of costs doing that. Now, this is the typical transaction between the asset seller and the asset buyer. And again, first, you have to find out that the asset exists, right? Then you need to make sure it's settled across this transaction against your counterparty, and then you need somebody to store it. And then there is like another counterparty, which is typically a broker or some bank, right, that facilitates all that. Now, the good thing about blockchain, and this is probably the most important thing for you to understand, that it completely disrupts this. So you can do all these kind of transactions in a trustless environment over a blockchain. And there are multiple blockchains, we can talk about that, but I will be showing examples on some applications over Ethereum network. But it's one very important thing to understand, that humanity basically created a way to settle financial transactions in a trustless environment without any particular intermediary being involved. And this is the first time in, I think, maybe 5,000 years. This is the history of financial transactions, basically since the first one where somebody settled his shells for apples and a human trade started. And it's a significant achievement that humanity can now experiment with this exciting technology and create a whole new set of applications we'll be talking about. Now, what is actually an asset on blockchain? What it is actually? So what could be a simple representation of an asset in a blockchain, and what we do as Stasis? So blockchain doesn't really know about our world, our state of the world. It's just a network that can facilitate those services like clearing, custody, settlement, but with assets that live inside that blockchain. So I've got a very simple analogy here that blockchain is a cloud for transactions. Imagine when the internet first started, the first websites were hosted on the servers, on the computers. Actually, they were not servers yet. They were just computers that were standing inside your organization or even your dorm room. In fact, my web server was first launched from the computer that was in my bedroom. But as the industry expanded and the services became more and more demanding towards the quality of the network access and the speed, latency, and so that, they went into cloud. And now Amazon Web Services, one of the biggest cloud service providers, where you can host not just a website, you can host calculations, you can host programs that run in your, say, cloud environment and make some calculations for you. But blockchain goes beyond cloud. It's a network that operates from all different parts of the world of the network supporters, and it has its native asset where with which all the transactions are being paid for. So for Bitcoin network, it's Bitcoin. It's a natural asset for Bitcoin blockchain, and all transactions have to be paid with Bitcoin. For Ethereum, it's Ethereum, right? And again, the network doesn't really know, neither of these networks knows anything about our world. But as we kind of started experimenting with all these networks, and we really liked the way they trustlessly do this type of services for us, a lot of projects, including Stasis, started thinking, okay, how do we bring some real asset from our real world from here, how do we bring like our apartment to the blockchain, so we can transact with it inside the blockchain and enjoy all this clearing, settlement, and custody over the blockchain instead of our traditional outdated and obsolete services. And of course, for every transaction, there should be some cash component, right? It's something people understand. We make money in euros, we pay taxes in euros, we know how much things cost in euros. That's just a natural way of human life, that people across different regions measure their wealth, measure their income and expenses. They dream in the currency that is circulating around them. So it's very natural, and it was a very simple idea to move euro or dollars from our traditional world into or onto blockchain, so the blockchain can know, okay, this is the dollars or euros inside my network, and people understand the value of it. The simple and now there are many actually algorithmic ideas how to implement an algorithmic what's called stablecoin on blockchain. None of them has succeeded yet. The only concept that has been quite successful so far, and this is what Stasis is doing, is a concept which is introduces a stablecoin fully backed by traditional currency. So say we've got 100 euros in the blockchain, in Ethereum blockchain, and in order for them to be created, we need to first secure 100 actual euro on the accounts of our issuing entity called Stasis. Currently, there are several successful stable coins, dollar stable coins. The major one is called Tether. It has more than 30 billion worth of tethers in circulation. The second closest is USDC. It's a dollar-based stablecoin launched by the American consortium of companies, including Coinbase, which is the biggest crypto exchange. And our stablecoin is called EURS. It's the biggest non-dollar stablecoin. Currently has around 50 million in circulation. And for every EURS issued, we've got collateral sitting in the accounts of the issuing entity. Now, once you've got that cash inside the same environment as the network kind of allows, it suddenly you can do a lot of interesting things. You can program traditional services like banking services, borrowing, lending, trading, and they'll be accessible 24/7 in a trustless environment by everybody just using his private key or mobile or hardware wallet. And I'll be talking about several of these platforms, which have grown quite significantly over the last year. The whole sector is quite new, to be honest. So while the blockchain technology, the blockchain software exists for more than 10 years, it's just the year 2020 where these major concepts in borrowing, lending, trading took attention and took some market share and users. Because people usually are afraid of new concepts, new technologies. They're afraid of accessing financial applications, especially when there are money at risk, right? When there is some personal wealth, some personal cash, some assets at risk, people are reluctant to move in first. They want somebody to experiment with those applications. But that's exactly where opportunity is, because right now, all this DeFi space still lacks institutional capital. And in traditional finance, you would never, it's never possible for an individual to buy, say, a government bond of Malta trading at 20 cents on a dollar, 30 cents on a dollar or euro, assuming finances of the Maltese government are strong and solid. And the reason for that is because institutional capital is very aware of all the market dynamics and market trends. and they are the first to buy or sell an interesting and lucrative asset in this space. For example, Tesla shares, as I'm sure many of you maybe speculated themselves with Tesla shares, but I doubt any of you was able to buy them in private rounds when they were trading pennies on the dollar, or even bought them right after the IPOs, or which happened several years ago at $8 or $6 per share. Most kind of individuals and retail investors have get to have access to interesting instruments, asset classes, only after institutionals put their hands on them, right, and trade them and create them and make them. And what's interesting phenomenon about DeFi and crypto is that it's probably first time in human history individuals can access all these interesting assets, all these interesting applications before institutions. Institutional capital is still not really present in the crypto space, especially in DeFi space, and that's why there is a significant opportunity. So we've got platforms like for lending. First of all, this was the main and most simple use case. How lending works? It's imagine you hold some digital asset, a Bitcoin or Ethereum or some other digital asset, and you don't want to sell it, either for tax reasons or just because you think it will continue to appreciate, but you still need some cash to pay either for your education, or maybe do some home repairs, or maybe buy a present for your partner. And what you do is you deposit these digital assets into a lending platform, and you borrow some amount of stable coin, say dollar stable coin or euro stable coin against it, and then you consume that loan which you borrowed, and then after you have your salary being paid to you or your tuition, you just reimburse that loan, right? Once you generate some cash flow in real life, you just reimburse that loan to a decentralized lending platform. And this is the transaction nobody can stop, nobody can prevent from you to have, because it all happens on the blockchain in a trustless environment. Trading was the second obvious use case, and people started experimenting with the DeFi trading after centralized exchange were hacked massively. Nobody really knows, were they hacked on purpose, or was it really a market hack? Every particular example is different, but since the industry is majorly not regulated, people were just afraid of this credit risk accessing a particular centralized exchange. So they started experimenting with the centralized exchange concept, and the projects like Uniswap, Curve, Balancer now dominate this space, and they have billions and billions in assets traded. I'll show you some charts later on. You'll see that some trading decentralized platforms already accrue more volume, more daily volume than some centralized. Next are the assets. So different assets on blockchain. As we saw in the previous picture, people always wanted to put some real world assets, and will always want to put some real world assets onto blockchain. Now there is the NFT craze going on. Basically, it's an asset that exists in a non-fungible form, say a piece of art, or a particular painting, or digital art, which is very fancy thing now, but also traditional assets like real estate, or gold, or even silver, to trade it and to extract profit of it, of its market moves, using the collateral you have in the crypto space. And then once all these opportunities to make money arose, there were people who deployed smart contracts that helped both retail and say some funds to automatically harvest those rewards. So platforms that help you to deploy your capital from a single standpoint. So you don't need to go over like 10 platforms, deploy to every platform a particular set of stable coins or Bitcoins or Ethereum. You can have a one door deploy a single kind of chunk of say Bitcoins or stable coins, and then the platform and smart contract will automatically harvest all the rewards, provide some liquidity to some other platforms, and generate yield for you, of course, taking a fee for that. If we just look at the lending capacity and how disruptive it could be and how underpenetrated it is, just think of what is the global lending market for the financial system. We have around 300 plus trillion in global assets. That includes stocks, bonds, derivatives, real estate, and majority of those assets are used as collateral to lend against. Elon Musk hasn't sold a single share of his stock, of his Tesla stock, but he borrowed billions and billions to finance his lifestyle, to purchase property, to pay for his private jets at something. So it's not only because he believes in the Tesla value long term, but because this is also a very tax efficient exercise. So if you sell your tangible or intangible asset, you incur an income tax if you held it less than a year, for example. But if you sell it, if you don't sell it but finance against it, you don't incur any taxes, and you can pay a very small interest rate on that loan. There was a funny incident where U.S. Federal Reserve dropped interest rates in 2008, 2009, and then regular Americans could not really get a loan at those rates. They were still receiving a premium, significant premium over the Federal Reserve rate. But Mark Zuckerberg got a home loan from Morgan Stanley at 1% per year for 30 years, something ridiculous, only because he had so many assets with that bank that the bank was very comfortable lending him money at below, say, or at market interest rate. But if we look at digital assets, they crossed 1 trillion recently. They appreciated rapidly last couple quarters, and the borrowing market is still basically non-existent. So it's just 2-3% of the total digital asset marketplace. And if we assume that digital assets are here to stay for very long term, they'll definitely grow massively. Then you can see how lucrative is the lending market, and what is the possibility of one not just approaching and crossing the regular one, but even as an experiment, it still has room and capacity to grow 10x, 20x from here, and still not even endanger the traditional financial system. Another interesting thing about digital assets and lending against them is that they trade 24/7, right? So your apartment, your real estate doesn't trade 24/7. It trades maybe once every few years. Your car does not trade 24/7. It trades maybe one every year, or similar examples trade maybe once every few months. Stocks trade 5 days a week, but from 9 to 5, right? US time or European time. Digital assets trade 24/7, and it's very easy for market participants to measure risk of that collateral. And if something goes wrong, collateral is easily getting liquidated. So that is another very lucrative opportunity for decentralized platforms to facilitate those loans, because they can always calculate the risks that they are taking and what are the opportunities for them to create leverage on these assets, or to make, say, digital asset swaps. So you can deposit an asset in Bitcoin or Ethereum, and take a loan in a digital euro or digital dollar, or even in other digital asset, say other digital token. It's also possible. So it's not necessarily you can make a loan in euros or dollars. You can make a loan even in other digital assets. So what are, again, the use cases of digital asset lending? I summarized very kind of the major four for every subcategory. So marginal trading, you have some Bitcoin, you want to go leveraged long, you deploy your Bitcoin to DeFi lending platform, you borrow some stable coin, and you buy more Bitcoin. That's a very easy and low risk way to go leveraged long without trusting your collateral, your Bitcoin, to central counterparty. Tax deferral, another widely used use case. Say in Germany, if you hold crypto for more than 2 years, you are not liable to any taxes for capital gains originating from that investment. So then you have it, right? So you bought some Bitcoin, it's been like 1.5 years, you want to sell some, or at least want to cash out some, but then you don't want to generate tax event. So you borrow some stable coins against those Bitcoins and consume partially those assets inside either, again, DeFi system, or cash out them into the fiat and buy something nice for yourself. Personal consumption is, again, similar example, not when you defer the taxes to be paid, but when you consume something using your crypto as collateral. Say you've got some emergency, you need to, or you decided to do some traveling, or you want again to buy a present for your wife or your loved ones. And then trading use cases. Again, cross-chain swap, it's something that blockchain interoperability, this will be a major topic for the next few years, I believe. Still, there is no one single platform that does it best. There are multiple experiments, multiple projects will continue to try to bridge those different blockchains and different assets between them. It's not easy technically, but trading already is possible. So you can say trade Bitcoin into Ethereum on a trustless, in a trustless environment. A low slippage stablecoin exchange. We started with the stable coins, and there were more than 250 projects announced in the stablecoin space over the last 3 years. Very few teams actually delivered, but a lot of people tried because the concept was so simple and so appealing that you can create a stable coin, it will be one-to-one, and you'll accrue interest generated from the reserves, and then etc. etc. So many projects were announced, but only few have delivered. But still, even those who delivered, they represent maybe 10 plus different stablecoins operating now across the cryptocurrency complex. And in order to go from one stablecoin, say BUSD, which is a Binance USD stablecoin, into Tether USDT, which is a dollar representation of on Ethereum and a couple other blockchains, you need some simple tool to switch between them. And you don't want to pay some significant fees, right? Because previously you have to deposit those stablecoins to one exchange, wait some confirmation times, then pay 25 basis points transaction fee to convert the stablecoin into some other asset like Bitcoin or Ethereum, and then convert them again on another blockchain into another stablecoin, which is not really appealing, because you are using basically the same digital dollar representation on blockchain, and you're paying up to 1% in fees just to go from one to another. So low slippage stablecoin exchange is a very popular product right now. One of the major platforms that pioneered it is called Curve, and I'll show you a bit later how it works. Trustless swap, right? And trustless trading generally, it's a very significant driver of this demand for major trading across DeFi space. You need nobody to facilitate that trade. You don't need any custodian. You're a custodian yourself. You hold private keys yourself. You don't need clearing agent, because blockchain clears that for you. You see the pool, the liquidity inside the smart contract, and you know it's there. You don't need any clearing agent. And settlement happens over blockchain the same way you send Bitcoin or Ethereum to your friend or yourself between wallets. It's almost instant. You know it will be there, and you just have to pay some network fee. And one significant use case that will drive the DeFi trading to the next level, which I truly believe in, is the crypto forex. What is forex market overall? It's basically a negotiation between major banks. We as customers, regardless if it's a retail or institutional, do not really know much about. So forex does not trade on a particular exchange. There is no euro-dollar marketplace where you know this is the exact quote, this is the exact size happening there. It's just a negotiation between banks. Say HSBC calls up Citibank and then negotiate a trade in billions and trillions in dollar or euro equivalent, and consumers, regardless, again, if it's a pension fund, if it's an institution, if it's a corporation, or just a retail person doing a transaction with his BOV card in America, for example, we know nothing about the way the forex market is really settled and traded. What I mean by that is that you say exchange dollars to euros at $1.20 per euro, but you never know if the actual market is, say, 119.55 or 120.5, right? And it may sound like a small incremental difference, but it makes significant difference in trillions of volume these banks and move around. And crypto can bring this market to light. It can open up this market in a DeFi form, and will allow everyone to benefit from the more transparent pricing. Because currently this is one of the high margin and most significant say profitable markets for the banks to transact globally, for global transactions. In fact, the one company I'm sure you all know about is called Revolut, made its business model exactly about it. It allowed you to convert euros to dollars at a very close to market rates. They made a whole customer acquisition strategy about it, and brought in a lot of users just because they allowed people to use a close to market rate, not exactly the market rate, because nobody knows what the market rate is and there is no place to check it, but close to it. But even close to market rate product got attention and significant demand from consumers. So imagine if DeFi, if there was a DeFi marketplace for crypto forex trading, where everybody can walk in and trade billions and billions in a transparent way. It will be a significant blow, of course, to the banks and their business models, but it will be, on the other side, a massive benefit to consumers around the world. DeFi assets, I think I brought already this example, Bitcoin and Ethereum. So Bitcoin and Ethereum are different blockchains, but you need Bitcoin and Ethereum to participate in DeFi. And there are several protocols like REN, WBTC, Binance also does their custody and do Binance BTC, Huobi does their HBTC. There are several experiments with bringing Bitcoin onto Ethereum network to trade it in DeFi, and they're quite successful. Synthetic assets is similar to synthetic assets are actually first experiment in this crypto forex space. There is a company, the project called Synthetics. They are the most famous, I think. They created a crypto euro, crypto dollar, crypto gold, crypto silver without having any collateral in physical form. Their collateral was similar to MakerDAO, which issues crypto dollar backed with Ethereum. So Synthetics issues different traditional, say, assets, backed by their native token. It's still an experiment, but it's one of the biggest one currently on the market. And through synthetics, our stable coin, for example, is linked to dollar stable coins via curve. I'll show you in a second. And then NFTs. It's something that is also could be an asset valued at millions and millions of dollars or euros. There was example recently, one particular digital art sold for 5 million euros worth of Ethereum. And it's a very lucrative idea that you again outsource clearing, settlement, and custody to a very trusted and hard to penetrate network called Ethereum, and you can store all types of non-fungible assets on it, art being a perfect example. Let me show you some of the protocols, the way they look and how one can access them. So this is the aggregator of major DeFi applications or protocols, a website called DeFi Pools. And as you can see, here is the chart of assets in the DeFi space across major applications, and it literally skyrocketed. So from the summer of last year to today, so almost half a year plus, the assets increased from 1 billion to almost 50 billion. And if you go here, down here, you'll see the contributors to this increase. So the biggest one is Maker. Maker is flagship project application on Ethereum. It was one of the oldest examples of a digital dollar called DAI. So what they do is you can deposit Ether, and then you create automatically via a smart contract a digital dollar called DAI, and then you can do everything you want with it. You can trade it into more Ether, or just deploy it into the lending pools to generate some yield, like a term deposit. Well, actually, it's an on-demand deposit, because when you put some collateral into DeFi protocols, you can always get it back. It's only up to you when you decide to get these assets back. You need just to trigger the function in the smart contract. So it could be, it's not a term deposit, it's an on-demand deposit. But since there is a lack of institutional capital, as we talked earlier, the rates are quite significant. Again, just to give you some example, once we are, as we are talking about it right now, let me show you how much you can make on your EURS deposit. For example, in the bank, you get 0 or close to 0 interest rate, and DeFi, you currently can have your EURS tokens, which is a 1-to-1 to euro, deposited at double-digit yield. Currently, it's around 22% per year. Yes, the rate is not fixed, so the rate fluctuates. Also, there is this band, depending on different conditions, you can get up to even 57%, but it's a significant interest rate differential between the traditional financial system, right, and the DeFi still. And to be honest, I think the risks in DeFi in most of the cases are actually lower than of traditional banking system, especially for the amounts more than 100,000 euro, because within the banking system, you're insured only up to 100,000. So your risk reward is pretty asymmetric. So you give your bank 100,000 or say 200,000, the best case, you get those 200,000 back. That's the best case, because you don't get any interest on that money. The worst case, you get just 100,000, plus you'll have to wait half a year until the bank is properly liquidated and the insurance fund is has to pay you. And I've got a couple of clients who had incidents with European banks going under. They had deposits of less than 100,000 with them, but still it was quite a challenge, and it took almost 7 months to get insured money back. Now, back to the list of these champions in the DeFi marketplace currently. So Maker is the top one. Yes.
So basically, like there's possibility even of 50% return, right? So my question is like, where is this money coming from?
Yeah, very good question. So you've got three streams that originate this yield. First of all, there is a transactional fee. As the DeFi protocol does not belong to any particular person or corporation, it distributes all the fee it generates to its liquidity providers. Imagine if a bank would be sharing his fee income with all his depositors automatically, not with shareholders, not with plus no overheads, right? So bank is quite a significant institution to operate with a lot of costs. Here is just smart contract. I mean, not just, it's quite a complicated program, but once it's deployed to the blockchain, it doesn't have any costs to operate. So all the fees you generate or the smart contract generate, let's see. So let me show you where the fees come from. Say a new user wants to go from euro stablecoin to dollar stablecoin. What he does is he accesses this website, and it's just a front end. So it's a front end to a smart contract. You can have like millions of websites representing the same smart contract. This is why it's unstoppable, because there is no single point of failure risk. You can shut down the website, you can take down the domain. It doesn't matter. The smart contract will continue to operate. This website is just an interface. If you shut down or somebody shuts down this website, there'll be millions of other mirrors accessing the same smart contract. And if you are smart enough, you can even access the smart contract from the smart contract interface of Ethereum node through a shell, Linux shell. But for simplicity, say you have this front end operating and you've got your EURS stablecoin, and you want to exchange it into the USDC stablecoin, which is a dollar one. Or, I don't know, let's choose, say, wrapped Bitcoin for a better example, which is a Bitcoin on Ethereum. So you can swap your, I don't know, a million EURS stablecoin into Bitcoin through this smart contract, and you'll get exactly this rate. But underneath the surface, it will be routed through synthetics, and there'll be fees which these protocols incur, and those fees are the first part, bigger part of the revenue that's being distributed to the liquidity providers. The second part of the revenue is the governance token of this protocol, what's it called? So if you want to add some new pools here, or decide on the smart contract fate, you need to vote over blockchain. It's another process that is being experimented with in the DeFi space, where the community decides on the future of the protocol. So say you want to add some pool here, or change some of these rewards dedicated to a particular pool, you need to vote with these tokens called curve tokens. And that's why they have value. Curve as a protocol distributes some of its tokens to every pool proportionally to the voted weight. This was the weight distribution, and that adds up to the revenue component of your deposit and makes this yield, say, 20+%, because the fee revenue stream is volatile. Of course, you don't have every day people transacting millions. You maybe have some day the volume is, say, a couple of million, the next day is like a couple 100,000. But then another revenue component is this token distribution of governance token dropped to the liquidity providers. And EURS currently has 3.44% of all tokens being distributed across all different pools. And that makes this yield, say, 23% per year currently. By the way, it was more than 100% per year end of last year when the pool just started. But since then, a lot of people deposited millions of euros. You can see the exact number.
Can I ask a question? Can you hear me?
Yeah, sure.
How do you view the flash loan platform, the lending platform Aave? Because majority of the coins being stolen is through the flash loan. And Cream, I think last month or 2 months ago, Cream's been hacked, and a big amount of coins being stolen. So, do you think it's a potential risk for flash loan, especially there's no collateral backed by that?
Yeah, very good question, and actually quite sophisticated one. I didn't know, Joshua, you've got such students who are that deep into the crypto space. Flash loan is something where a smart contract can take, or a user can take from a platform some funds with one condition, that these funds are returned in the same block, same network block. Currently, network blocks average 15 seconds for Ethereum network. So this is, imagine this is like a very, very fast loan, which you have to take and return in 15 seconds. The way you do it is only when you know you can do some arbitrage with it. Say there is some stable coin trading on one platform at X, and then the Bitcoin is trading exactly X plus whatever percent premium on another platform. So you construct a program that takes this loan, collects this arbitrage through the chain of other smart contracts across platform, and you return this loan to the originator. Of course, originator also wants some fee for this loan, so you have to account for all those expenses. Of course, flash loan is still a massive experiment, as all these DeFi protocols. And it's obvious that if a hacker to find some vulnerability in a particular smart contract, he would take some other money, right, to exploit it. It's very natural. First of all, it hides the trail. And second, it allows you to scale this vulnerability. Say you found vulnerability for €1. If you take 100,000 or 1 million in loan, you can increase your potential profit. I think there'll be more. So now back to the question, I think there'll be more governance restrictions in form of these protocols that will slowly migrate to some reputational system, like a credit score. Credit score in DeFi is a very interesting and topic of the next of future, where you can accrue some trading history, you can accrue some governance tokens, and then end up with some credit score. Say this particular address could be trusted for X amount of capital in form of a flash loan, and a fresh address cannot be trusted. I think personally that all the hacks are for good, and they help the system to evolve. They help the engineers, the developers, the ecosystem participants to learn about the opportunities that are provided there. So longer term, they are very good. Short term, of course, protocols suffer. As you mentioned, Cream is one of the funny lending platforms out of Taiwan. They lost more than $1 million in their treasury funds, and also through their platform, another smart contract was able to steal 11 million worth of stable coins, I believe. It's of course it's it's something that the community have to deal with currently, right? So they have to come up with some compensation schemes. They're working on it, and they came up with some solutions. Relative to the total market size, I still think it's not a big deal. So Cream still has like 220 million here, 150 million here, and then on Binance chain another 70 million. So they have more than $500 million in assets. As you can see, some assets fled, but most assets stayed. So that means people treated the way I emphasized. Okay, it's a short-term loss, but for the long-term gain. Okay, did I answer a question? I thought about implementing a flash loan inside the EURS smart contract, actually, because that helps even out discrepancies across the DeFi complex. Because assets trade against each other every single second. So there are sometimes arbitrage opportunities. And if there is a flash loan that's easily accessible, there'll be natural hunt, natural demand to even out those price fluctuations, which in the end will result in a better user experience. Say today there was more than $1 million equivalent EURS traded on Uniswap, which is one of the biggest decentralized trading platforms, right? And as you can see, this is the chart of EURS relative to the dollar equivalent, and it fluctuates from 1.24 to 116, right? Quite a wide band. You don't see Forex market fluctuating that bad, of course, because they're more liquid. The bad thing about Forex market is that you don't see the actual marketplaces for them, right? You just see the rate that some bank is quoting you. Doesn't mean you can transact at that rate, at that particular rate or of a particular size. As you can see, the euro has been dropping recently, and it's now trading around 1.1867, right? EURS on Uniswap is now 1.21. So that there you have it, some arbitrage opportunity. If there were a flash loan easily accessible, then these arbitrage opportunities would be more widely exploited. But so far, I still consider adding a flash loan. I still haven't decided. Of course, weighting all the pros and cons. All right.
I have some questions.
Sure.
One is, I think Alex asked this question: how do you get how do you print money? And you said it's based on transaction fee. Is there any other way as well through which you get more printing of EURS?
No, EURS is pretty straightforward. It's just money. It's just tokens against money. So currently there are 47 maybe million outstanding, and we have cash for exactly in exact same amount. So that means that whenever a new user or a new kind of customer walks in and sends some cash, that's the moment where EURS is being created. So it's always one-to-one. There is no other way currently to create EURS other than my sending money directly to Stasis. There are some secondary markets that operate, but they charge some trading fee. Their business model is to sell EURS, say at 1.0025 and buy it back at 0.9975. So they make 25 basis points on every trade, and that's how they make a return on their capital.
I see. What I mean is, how does Status earn money? It's on transaction fee.
No. Very good question. So Stasis started as a transparent project, transparent stablecoin project to challenge Tether. Stasis is one of the oldest stablecoin on the market right now, and Tether back then was completely non-transparent, not audited, and most people thought it doesn't have the collateral it claims it has. So my idea of creating Stasis was first to get rid of US dollar. I think the US dollar is going down long term. And second, to bring transparency to the marketplace to create an instrument of a very low credit risk component, with a very low credit risk component. Now, fast forward 3 years, we can see that Tether still continues to exist, still operates, and the dollar stable coins dominate this space. Maybe we were too early in this sector, in this play. Maybe we just now, with this DeFi game starting, we'll see a significant growth of our assets. But the idea was to operate this as a money market fund. And as a money market fund, you can make money if you have 300, 400, 500 million at least of cash. Because on the end, you can make, say, conservatively 1% per year, allocating that capital to fixed income securities, government bonds, and stay safe. Do not expose those funds or the customer funds to significant volatility risks. But as things stand right now, there is even a bigger amount of capital needed because interest rates went lower into the negative territory. So when we started, the Maltese 10-year bond traded at 2%, almost 1.5 plus. Now they were below zero recently. So that makes it, of course, challenging to operate this as a business. But Stasis was like never built to extract value just as business. For me personally, Stasis is a charity to crypto community, that a proper stablecoin should exist in the space anyway. And once ecosystem around it develops, we'll find some ways to make money off secondary markets or maybe in DeFi space. For example, now you can farm some crypto forex governance tokens called DFX Finance. It's just a new project that's being launched, and they chose EURS as one of their key components of its infrastructure. So they created a pools on balancer against USDC, EURS, and XSGD. And there is more than 15 million of EURS already deployed into this smart contract. And this is a first attempt to create this smart crypto forex trustless environment. So we'll see. Stasis will definitely benefit if that project takes off. Okay, back to the other DeFi champions. So AV we talked about. Compound is another DeFi lender borrower. You can deposit Ether, DAI, get some yield on your deposits, and then make some loans against those. AV is a pioneer in flash loan space. Me personally, I like AVE better, and Compound was the first to market. That's why it's still here. Uniswap is one of the biggest trading interfaces, as we saw here. It's a trustless exchange where you can swap one token into another. There is multiple number of pairs and tokens here. The list is quite long. But as you can see here, the volume is quite significant. So this is the total liquidity available in the protocol. So 4.4 billion. Just think of it. It's staggering amount. It's bigger than some small banks, some small Maltese bank have in their balance sheet, right? And this capital is deployed to a smart contract, to a program with zero legal liability. So it's quite an experiment, which is fascinating to think about. But it's working. This clearing, custody, settlement service it's offering is very appealing to customers. As you can see, liquidity is growing, the volume is growing. The daily volume flowing through this DeFi application is 500 million constantly for the whole start of this year, 500 million per day. And this is a volume that cannot be faked. This is the volume that is everybody can see what were the transactions. It's a very transparent, clear volume. As fees in Ethereum are quite high, it makes 0 sense to fake it. It makes no sense to try to inflate it. It's a pure demand for this particular product originated on this platform. People are swapping Ether into wrapped Bitcoin, into DAI, into Uniswap tokens, into other different project tokens, and there is demand for it. And there is still very little institutional capital involved. Otherwise, the numbers would be much more massive. Actually, I was the one who was probably one of the first crypto enthusiasts talking about institutional capital back in 2018. I even had several presentations in business schools where their idea was that crypto marketplace is the first experiment in human history where retail people or just individuals can get a hold of a particular application of a particular product before institutionals. Now you have Tesla investing into Bitcoin, MicroStrategy investing into Bitcoin, and over the weekend we got news that some Hong Kong listed company invested into Ether. Of course, significant force behind this is the low interest rate, or say negative real interest rate. But as Elon Musk tweeted, it was inevitable at some point. So yeah, Meitu, a Chinese company that makes a photo editing app, right? So there, it's not a financial company. It's a photo editing app company, purchased Bitcoin and Ethereum. I've got some ad block here, but you got the idea. So it's just starting, and the reason the corporations, institutions are slow to move there are two main reasons. First, they lack the expertise. They lack this feel of this technology that it's safe. You've got to have some computer science background. You've got to understand economics. You've got to understand finance. And only then you can just start to understand how disruptive it is. And second reason is they fear that blockchain will massively disrupt their monopoly for clearing, custody, and settlement. So we spoke about AIF, we spoke about Uniswap. Curve Finance is another top project that allows you to swap between cross-chain assets, say Bitcoin and EURS, or assets that are not priced in same currency, or assets that are priced as same currency like dollar stablecoin, but with the smallest slippage. Slippage is the amount of the amount you pay, the amount of fee you pay when you swap, say, one asset into a similar asset. For a crypto market, dollar stablecoin should be priced relatively same. So like DAI is a dollar stablecoin, should be swapped into USDC at almost no fee. Although historically at cryptocurrency exchanges, there was some massive fee to swap that. But now through Curve, you can swap 10 million of DAI into USDC with one click and pay very little fee. Next is Balancer. Balancer is similar to Uniswap. It has a network of pools where you can swap different assets between one and each other. They also pioneered a concept of a liquidity gathering auction. This is a new way to conduct fundraising, where a project floats its token and then community supplies some stablecoin or Ethereum to buy it, and then the price gradually is formed through the time of this auction. Okay, so I think that these are the main examples. You can check them out on DeFiPools.com yourself, and you just need this little MetaMask. This is a blockchain wallet which allows you to transact with Ethereum and you can download it as a Chrome extension called MetaMask, and you can see it for yourself. This is the only thing you need to be a part of the decentralized finance world, which is quite exciting. Okay, I have a very nice picture here I wanted to share with you guys. So, because this is the question I'm very frequently asked, like, say, okay, you've got all these interesting protocols, interesting applications, there's so many things that could be done, but what if things get restricted, shut down, or your internet access is revoked? Now,
please, it was one of my questions, Cyril, here. You know, it is like the case where what if the electricity go down, or what if, as you know, I mean, I don't know exactly, but it is told that it is in China that there is a 60% of the control of the mining power of the Bitcoin. So it is a what if scenario, but you know, our current world. Anyway, if the electricity go down, I mean, everything stop running. But can we see some case where how could this all these blockchain things could be attacked, or is it fireproof from everything?
Yeah, well,
you know, I'm a blockchain enthusiast here. I'm here to work on all of this subject.
Well, first of all, if electricity to go down globally, I think humanity will be in a much worse situation than just without the financial services or clearing, custody, settlement services. If the electricity to go down in some places of the world, that's what decentralization is for. You will still be able to access those networks that will be supported by the remaining part of the society, of the humanity, that will still have the electricity. And then the question will be just for you to get to that network, or say to the place where electricity exists, or use some potentially a broker, because you can sign transactions offline. Potentially, you hold your keys and you hold your asset yourself. So potentially, and we had some concepts of total firewalled countries like China, and how could the blockchain survive there, is that the transactions then would be processed manually by some courier who would be developing those signed transactions in a physical form on some hardware device, and then replugging in them to the network once he gets to access that network. Of course, that will increase the transactional fees for that particular asset owner, but it will not stop him from transacting or losing access to his assets. So I personally think this is so disruptive that it could be compared to railroads and just I don't know, town roads 200 years ago, cars versus to horses 100 years ago, and internet relative to, you name it, service that was disrupted by internet. And in every single example, there were like hundreds and thousands of market entrants. Similar to railroads 200 years ago, there were dozens and hundreds of companies trying to build these rail networks. And now you've got what, couple, say, okay, let's take United States as example of pure capitalism for say 150 at least years. I don't think what's now happening is capitalism in the United States, but for the sake of simplicity, let's just imagine they started with a pure capitalism and then it ended somewhere in 2008. So railroads, perfect example. Then cars. Do you know that car producers were attacked by people who rode and bred horses, and the humanity did not believe the cars will be here to exist sometime in the future? Nobody really believed the cars can disrupt horses, and the cars is something that is better for the humanity long term. But as fast forward 100 years, everybody is using cars. I saw some horses on Malta, but they're not widely popular. And then, but those things I read from historical books, right? I didn't remember them, of course, myself. But what I witnessed myself in the front line, I was sitting in the internet front line out of my apartment and building the network to access internet without a modem over a faster connection. It was a DSL connection back before optics and fiber optics came in. And it was exactly the same thing. There were hundreds and thousands of companies trying to build something in internet, and only few, of course, survived. Only few major companies that we know these days were created back in those days. And even YouTube, which is now the most famous, right, internet app, that completely disrupted television, was not the first one that created the video streaming over internet. There was a company called Real Networks that still exists by this day, actually, but of course not the magnitude YouTube is. Real Networks capitalized on some patents they smartly received in the United States. But they created this video streaming technology back in 1994, and they had the real player that was operational in 1996. And I was actually using it, and it worked okay if you had some broadband connection capable enough. So, sorry. So yeah, there were multiple examples when a new technology kind of disrupts traditional way of doing business, traditional way people tend to live and experience. And then there is a lot of anxiety, there is a lot of superstition, and only over time, once the generation changes, once people get used to it, they understand that this technology is here to stay. And suddenly the valuations completely reprice. So no, blockchain cannot be stopped regardless of the particular countries deciding to shut down electricity. As long as internet exists, there will be blockchain. There will be some network that people can access and do clearing, custody, and settlement through. And that will slowly but surely eat into the launch of major banks, financial institutions, and you name it, counterparty who were monopolizing these services for hundreds and hundreds of years.
You answered me. Thank you. I agree with you. I wanted an expert point of view.
All right. I think this is something that I wanted to share with you guys. It was, I think, the first experiment of this kind, providing some DeFi lecture across Malta University. So I would really love your comments. If you have some additional questions, if you want to share your concerns or your ideas, please feel free to reach me over email. We at Stasis will continue to be here and govern the biggest non-dollar stablecoin. That's our mission. We created the first and the biggest non-dollar stablecoin, and I will continue to execute on the strategy to become the biggest, to remain the biggest non-dollar stablecoin issuer. We are hiring developers, front-end developers, back-end developers, mobile developers, and some project managers. Mostly it's computer science talent, but if you think you want to work for Stasis, please also drop me a note, let me know. And I also encourage you to try our stablecoin wallet. It's very easy to use, non-custodial wallet, which you can download to your mobile device and access Bitcoin, Ethereum, blockchain. We are migrating some of the functionality to purchase stable coins with Visa and MasterCard, but the blockchain functionality is available. You can send, receive Bitcoin, Ethereum, other stable coins, and just feel for yourself how it works. And then once you're comfortable with that, you can try DeFi. I think it's one of the most exciting opportunities available now in the finance, computer science, global macroeconomic space globally.
Excellent. Thanks, Greg. I guess we can go to some questions now.
Yes, please.
I had a question related to DeFi. Is there anything other than lending and borrowing in this space? Or is it all about, like, DeFi is only about lending and borrowing and that's it?
Okay, so there are several applications, I would call them. As you can see, this aggregator classifies them a little bit different. It's called payments, then lending and borrowing. Then there are DEXs, derivatives, and assets. I shared just the biggest one with you, but the list is quite long, so you can scroll for yourself and try to understand what a particular application is doing. It's obvious that trading and lending and borrowing are the easiest use cases, but there are multiple others. For example, margin trading, the product that was historically also oligopolized and run just by centralized counterparty, because you cannot really loan over blockchain more amount that you hold in collateral, right? Because you don't have any legal claim on the borrower. But there are some projects that are experimenting with this margin trading functionality, and I'll see. I think later this year we'll see more progress around DeFi. One big obstacle still is the network capacity. So think of DeFi applications like YouTube videos, but we are like in the year 1998 in the blockchain space. So the possibility is there, but the capacity completely is not. Because not everybody has a broadband at home. There is no iPhone, no mobile devices can stream and create and record those videos. So blockchain or Ethereum blockchain to some extent is an old internet that's not scaling well. We'll see some progress with called layer 2 solutions this year. Ethereum 2.0 is about to launch later this year. There are other blockchains, of course, like Polkadot, Cardano, Algorand. There are multiple things happening in this space. I just showed you like a tip of the iceberg.
Greg, I would have a question. Now I think a lot of protocol, or not a lot, but some protocols are creating these kind of fixed income products that are basically tranching the underlying risk. Have you had any look on those? Would like to hear your opinion on those if you have any.
Yes, of course. They're called asset management smart contracts or asset management protocols, as with the most famous example probably called EURS Finance, which was fairly launched last year. How they call it? Fairly launched means that there was no any external funding, there were no like venture funds, there were no investment funds participating. There was just a community who participated in the smart contract creation that ended up receiving these government's tokens, which by the way now are quite richly valued. Just to give you some perspective, let me show you.
No, but I was more talking about like bonds. They're creating like bonds. So that's not the same thing, is it, that they're doing?
The bond on the blockchain is an instrument to avoid settlement and clearing, custody and fees in traditional banking system. It's not the asset management product, of course. If it's just a bond on the blockchain, it's a security that an originator tries to move some.
Sorry to interrupt.
Yeah,
I have something because I told Jonas like not a long time, but I told him to put more focus on basic bonds, which is a part of basic stablecoin. I think he should go and look at it. So it relate my question, but You can continue, but I will.
Yeah, well, I was talking like protocols like Barnbridge, Saffron Finance, Opium Finance, and they're kind of creating new approach to risk, where they're kind of using these money markets like Aave Compound and others to, and they create like different kind of risk tranches behind it, where you have certain kind of maturity and fixed like yield for it. So that was kind of the idea, but maybe I was not able to kind of explain it correctly.
Okay, well, EURS creates something similar, although without layers of seniority. So there is the approach you are targeting to is a more sophisticated one, when there are different tranches and say an idea of the capital seniority replication from the traditional finance, where there is like equity, which goes to zero if things go south, right? Like senior bonds, collateralized bonds, or some unsecured bonds. The EURS is simple to an extent that it just collects the maximum yield you can get. So say in Curve, you can deposit EURS and get 22%. In EURS, since it auto-harvests everything and gets some boost, you can get this yield up to 58%. But yes, you deposit this EURS directly into EURS, and if EURS things happen with EURS, it will be liable to some extent to give back your deposit. What is being solved right now is some insurance, and there are several insurance play, Cover, Nexus, Bridge Mutual, some others across other chains and on Ethereum that try to implement a credit default swap, basically, where the users will be able to stake some assets in the insurance smart contract, and an insurance smart contract will ensure some of these yield aggregators or asset management platforms on the actions their smart contracts are taking. I don't want to go into much of a detail in this because it's still a significant experiment. So DeFi is an experiment on its own, and I'm sure it's here to stay. But this is like a number 10 experiment that is happening inside DeFi. The way to select those seniority among tranches, different types of bonds, either a direct insurance of a smart contract, of a particular smart contract. So say you've got this, again, EURS pool and Curve for 58% per year, and then some insurance smart contract will be able to insure it for 10%, right? So your net yield is just 48%, but you spread your credit risk across two issuers. Maybe that will be a more easy product for an end user to understand than just by going into different tranches, because you agree, right, that it's not something an average, say, depositor should be involved in or get knowledge or be knowledgeable about. When you deposit money into Bank of Valletta, you don't really know what are the underlying tranches and how they're consuming it. So in DeFi, I think ultimately there'll be very simple products like deposit X, deposit Y, deposit Z, with different set of risks attached to them. But currently, it's still all an experiment.
I think what dealers meant was fraud. I mean, the tranches, maybe CDS. Maybe you wanna maybe a pack of the securities can be issued for someone who's in getting interest. You can get interest from the securities. So I don't know if you meant by that.
The problem is that there are multiple risks that are intersecting here. On top of just the individual idiosyncratic asset risks, say a stable coin, even USDC or USDT, it still has risks, right, in it. That risk has to be priced somewhat at some price. And there has to be a market for that risk. And that's just one risk. But then you add one smart contract, it has another risk. Its risk also has to be priced. And I mean, and you get the idea, right? So there are multiple smart contracts, multiple assets involved, multiple risks. When you combine, when you try to price the total risk, it should be much, much higher than every individual risk, because the risk of a combined structure always multiplies. It doesn't even adds up. And then on top of it, you've got the Ethereum risk, which is also has some risk inside of the network, right? It costs something to attack Ethereum. and its risk can be quantifiable. I had this concept of trust quantification to a blockchain in general, where yes, institutions or individuals can assess themselves every particular moment how much we can trust this particular blockchain in assets, in value. Like, what is the cost to disrupt this particular blockchain or attack Bitcoin or Ethereum blockchain? This is the reason actually the whole DeFi space is evolving rapidly around Ethereum, because people still do not understand how to price risks of other blockchains. They know that Bitcoin and Ethereum are the biggest and the safest, but they still do not know like what would be the cost to attack, say, Tron network or EOS network or Binance Smart Chain, right? Binance Smart Chain has been on the rise last couple of months just because it's so easy to migrate from Ethereum to Binance. It's fully support Ethereum virtual machine. But Binance Smart Chain is the centralized database. It's like a set of computers operated by Binance management. What's the credit risk of this network? It's definitely high. It's not low, but it has to be added to those protocols and to the products that are trading in these protocols. So ultimately, when a user see, say, 100% interest rate on some product inside Binance chain, maybe he's even actually undercompensated for the risks he is taking. You see what I mean? So if, say, you deposit whatever amount of capital to a counterparty at 10%, but the risk of that counterparty is 20, you're actually losing 10% in the form of risk exposure of your capital. So it's all very sophisticated and like a lot of food for thoughts, but totally not explored across the blockchain space yet. And we need institutional capital to start entering the space to at least try to conduct these experiments, right? To at least to address them and try to measure some risk. Again, with the credit default swap example, they were created when ExxonMobil, which is the biggest oil producer, had an incident, oil spillover accident, Valdez, and then there was significant risk. Will the company survive, right? Will the government impose like 10 billion or 100 billion fine? And JP Morgan employee, Catherine, I think, invented this credit default swap instrument which allowed JP Morgan to migrate some of the risk off its balance sheet and sell it on the market and to price that risk. So we need some similar processes to start happening in cryptocurrency space, of course, for that risk to at least start being priced at some level. Unfortunately, for the traditional financial system, that risk pricing exercise ended in 2008 when just central bankers said, okay, these institutions are too big to fail, their risk should be priced at close to zero, and we'll see how it goes. I have a lot of hopes that the blockchain can be that libertarian risk pricing environment where ultimately we as humans figure out how to address and price those risks, and once capital fills the network of products and sets of these tools, we'll see a more fair distribution of those risks and more fair pricing of those risks. And we'll be able to, the good thing about it, they'll be very transparent about it, right? About the whole thing. So we'll see everything what is taking place. When JP Morgan was selling off its Valdez credit risk off the balance sheet via CDS to some maybe even not a public entity or hedge fund, we as ultimately taxpayers, we knew nothing, right? And in 2008, we knew nothing about the state of the balance sheet of the Lehman Brothers, and ultimately had to come up with a lot of social financing to save them. So I think this is impossible in blockchain if it stays in such transparent way it currently is. And this is a good thing about it. And this is the main value proposition of this clearing, custody, and settlement disruptive products I'm talking about.
I do have a question. Yeah, you relate to algorithmic stablecoin. So how do you view this kind of stablecoin? I know there are Ampforce, and base coin on Chain and Frax, etc. How do you view those like special stablecoin?
Yeah,
Do
very
you
good
think that
question.
because they definitely have in a way to get an arbitrage from the market, and you were mentioning about flash loan, so that could be potential arbitrage. And do you think that this kind of special stable coin would have last longer in the market?
Mhm. Yeah, very good question, and it comes timely as we were discussing credit risk and the way to price those credit risks in blockchain. The thing about Algor stable coins is tied very much to this question, actually, to the way and the formula to determine the rate of volatility risk of this stable coin. The market has had a very nice example of this phenomenon when DAI was trying to maintain its peg when the Ethereum volatility was through the roof. So Ethereum was going kind of back and forth in the previous cycle from say 1400 down to whatever $200 per Ether. And that volatility translated in significant uncertainty for the DAI as an instrument. So again, it's back to the point: you cannot get rid of the risk. You can only resell it. You can only kind of move it to some other holder or balance sheet or some other instrument. You cannot really get rid of the risk, and this is why the volatility risk of all algorithmic stable coins will be very, very, very high for a considerable amount of time. That means that borrowing rate, say you want to borrow those stable coins, will be definitely double digits, even maybe triple digits in some cases. And that means in turn that it will never be used properly for arbitrage, market making, and liquidity fulfillment concept across the trading ecosystem. DAI interest rate, borrowing interest rate, stayed as high as 20+% during the time when Ethereum was going down. And they made a lot of efforts trying to trim it, trying to reduce it. And the only way they managed to reduce it is by adding what? Collateralized stablecoins. Because only collateralized stablecoins can have the closest risk price to the traditional risk pricing of, say, euro, dollar as a currency. Why? Because the volatility of the euro or the dollar as a currency is something people understand. They know how to price it. They have statistical models. They have liquidity there. In order for that to translate to the cryptocurrency marketplace, you need some analog, some copy, say, of traditional currency in the blockchain. That's why EURS has the smallest and the closest rates to its euro parent. And for example, Tether also has high interest rate, borrowing interest rate component, because there is the risk, embedded risk of non-transparency inside it. And there is always demand, first of all, to borrow it, right? So imagine you know Tether is under collateralized. You would be willing to borrow it to sell it at par, because what's your downside? Just the interest rate. Tether will not go to 100, it will not go to like even 1.1, right? It will always stay at par or go below par. It's actually similar to Michael Burry's strategy of shorting mortgage bonds back in 2006, 2008. He was shorting junk-rated bonds that were on paper rated as triple digit just because everybody thought they're fine, but the underlying assets were impaired. The underlying assets had a significant potential discount to its fair price. So that's why the guy was borrowing them and shorting them, because the interest rate to borrow them was low. Now, if that interest rate grows, suddenly you realize maybe not so good the assets that inside this box are. And this is the same problem with all algorithmic stablecoins. So until they give the market comfort and try to bridge this gap to
that's
this,
the paradox
yeah.
here. So
Sorry, what?
the majority of the market right now circulating USDT. So I don't know how much percent, but at least 70% of people are using USDT. So if let's say if they don't cash out, they don't like run on the bank or run on the tether, which means the tether, this company, even though it's under collateralized, it will not be broken. So they can remain in this form and everlast.
Yes, but still the interest rate to borrow Tether will remain higher than, say, other fully backed and more regulatory friendly stablecoin as GUSD. That's what I'm telling you. Look, the GUSD interest rate to borrow is 3.9, while for Tether it's 16.9. So that there you have it. This is the interest rate premium the market already prices on Tether. Just because if the Tether, like if the interest rate to borrow Tether would have been, say, imagine at 2%, everybody and their brother would have borrowed Tether and just shorted. Because what you have to lose? 2% per year, but what you have to gain? 50%, 30%? What's the downside if there is an attack on Tether? Last time it fell to, I think, 70 cents on a dollar. When there was a previous attack on it a couple of years ago, it fell to 69 or 68 cents on the dollar. So there you have it, very low risk trade with a high asymmetry. This is what every hedge fund, every good trader likes. He likes asymmetry of rewards. Worst case, you lose 2%, ideally per year. Best case, you make 30% in one night, right? Or 50%. So this is a trade I would take every single day. And this is why this interest rate and risk rate is so important in pricing of these assets. And of course, the ideas and the concept of risk pricing will transition to cryptocurrency space from the traditional finances, because they have just, we don't have any other ways of creating the same mechanism inside this network. It's just the network is transparent, but the interest rate concept and the risk determination concept will be borrowed, or is already being borrowed from traditional financial system to replicate it in the crypto space and to determine the risk metrics of a particular asset. For example, Bitcoin. See, the risk of Bitcoin is very low. That's why it's very cheap to borrow it. Very cheap. Also, so there is like embedded risk, then there is inceptive, like volatility of an option. If a lot of people think something is going up, there is a very high likelihood that the option to bet on this asset going down will cost very cheap. This is what's happening with Bitcoin right now. Everybody thinks it's going up. Institutions are buying, corporations are buying. So nobody is really selling or borrowing it, right? That's why the interest rate is so low. It's probably the lowest among other assets. Same is happening across the stock equity complex. When somebody starts shorting the stock, he needs to borrow that inventory to sell and inflate the interest rate component of the stock, or the risk component of the stock, if you want. So I think until algorithmic stablecoins find a way to mitigate that risk or reduce that volatility risk, they'll always trade a significant premium relative to other stablecoins. They'll trade definitely at a more premium than even Tether, and that will mean they'll have less and small adoption, or hard to penetrate adoption. Look at Tether. It doesn't widely used across DeFi. In DeFi, people tend to select the credit risk they like. So when people have an opportunity to use a stable coin in DeFi, they don't use Tether. Look here, for example, on Ivy, the market size on USDC is twice bigger than for Tether, although the Tether generally is 3 times bigger or 4 times bigger than USDC. So Tether is used by predominantly centralized exchanges that has significant credit risk. If they were to price their risk on the market, it would maybe cost 20–30% per year, because those exchanges are unregulated. They don't have any bank accounts. Nobody wants to bank them for exactly the same reason. Their risk is too high. So there you have it.
But I think, I'm sorry, but I think I still have like hold this belief that DeFi market is a semi-efficient market. So if the arbitrage is spot on, the market will adjust quickly. And if this arbitrage, let's say it's on the table, so everyone sees it, so the market would adjust quickly than never. So even though there's arbitrage there for algo stablecoin, but I think it can last longer.
Well, we'll see. I'm keeping a close look at Basis Cash. This is the flagship project in the space. They had this concept of bonds, which are senior, which you convert your Basis Cash into, and then wait until it trades back to par.
Yeah, it's like US dollar, US bond, US shares.
Yeah.
It's the same logic
Yes.
applied.
So we'll see. Currently, their risk rate is triple digit. That means, yes, that means they have to pay a lot of capital just to stay afloat. And usually you cannot pay a high weighted average cost of capital for a long period of time if you're not producing some productive and widely demanded products. This is where actually the capitalism was invented. It was broken when this risk market risk determination formula was impaired by central bank, just saying, okay, these are the institutions that risk zero bankruptcy or will not ever go bankrupt. That's the moment where this whole risk pricing concept went into trash. But in the crypto, it's all over the place. So Basis Cash enjoys exactly the cost of capital they currently deserve. If they come up with some Binance Smart Chain Bridge or some better product to pull some other stable coins into their stable coin, or to introduce some additional liquidity that will help its token come back to the peg, you will see how their interest premium will shrink, their borrowing cost will decrease massively, the liquidity will increase, because that's the inverse function of the risk associated with the price. And maybe they will not trade to par, but I think it could easily trade like 2 times from this price, and still, so it will trade again maybe 80–90 cents on the dollar, and still will not reach its parity to the dollar ever, but then its risk will be valid maybe at 30–40% per year, and then we'll see. Again, it's still an experiment, like I said, but you can watch it real time, and it's truly fascinating to do so.
Greg, please.
Greg, Joshua, may I?
Yep, go for it.
Stephen, okay. Greg, thanks so much for this exceptional, presentation. It's fantastic. But the point is, I'm Joshua's colleague at the university. The point is why we're discussing within the framework of the classical asset pricing theory or risk measurement up until now. We're talking about CDS, CDOs, or whatever, or risk, or measuring the risk, or having some fixed income products now. We are discussing somehow under the framework of the classical asset pricing theory. We need new asset pricing models now. We have to forget about this kind of discussion. At least that's my point of view. So now, and the idea, of course, of the flash loans, it was a bad idea. It was too premature. So it's like having a naked sword or something like this. I mean, even in regular markets, you have the arbitrage opportunities. Everybody's going to have. You have the scalpers. Everybody's going to go for it. Okay, so we should abstain. We should not talk at this point. I mean, at least now. Now, remember, even 3 or 4 years ago, we had a Nobel Prize committee awarding Nobel Prizes to Pham and Schiller. I mean, one guy that was for efficient markets, other guy was completely for inefficient markets. So we should not, in my view, this is an oxymoron now. We should not get into this kind of discussion in terms of the classical ways of calculating the idiosyncratic risks or prices or whatever. We should let it cool down a little bit. We should let it flow. We should get liquidity. We should. We have a new round of operational risk, market risk, whatever. There are new concepts now. These are new. The concepts that we already have are out of the table, in my point. So, yes, I would like really to have your take on this. This is very important to me.
I totally agree. I totally agree. In fact, I did my attempt on write some paper on an asset pricing formula in digital space or digital asset, because there are no traditional cash flows you can discount here, right? You need to measure all the intercomplexity and the interconnections between the community a project originates, between the added value or network effect it creates. So it has so many moving pieces, and I totally agree. Somebody one day will get a Nobel Prize for coming up with some interesting pricing formula for digital assets. But as you know, with options, Blackfisher Scholes got their Nobel Prize 30 years after creating that paper, and maybe 50 years plus after the instrument started trading. So
and they bankrupt, if you remember, and they bankrupt.
Yes. And,
they got bankrupt,
and then the fund, the LTCM that was trading went bankrupt and had to be bailed out. But I hope this time things will happen faster, as we have information moving faster now, much faster. So I hope we don't have to wait 50 years to get this pricing formula.
And we have the transparency of smart contracting, so we will know the formulas. Man. We can write things, and they will be transparent on them. At least.
One question here, Greg, please. How do you organize your intelligence on this DeFi domain? I mean, what website or forum do you like to monitor, or do you know some study materials somewhere or use cases? Do you have this kind of, how do you do?
Well, I like all the traditional aggregators like CoinMarketCap, CoinGecko, DeFi Pools is great, dbank.com is nice, DappRadar is another one. I mean, these places start to show up like mushrooms after the rain right now. You can watch Reddit forums, Discord is great, Twitter is amazing in DeFi. So there are so many social networking tools right now, and the DeFi is slowly but surely conquering minds of the community across the world. The main language is English, so it's very easy to communicate and read what people think and do. And then you can also read through white papers of the projects. You can say go to the ICO radar or ICO drops and see what the projects are doing, what are they conducting their fundraising, or what the project news are, and then you can read through their white papers and then gather some information there. There is an abundance of information. I mean, you can spend literally weeks going through it. We had one question from Nikolaos, I think, who was...
Hello, Greg. Thank you for the presentation. I'm curious because I'm checking the data from CoinGecko, and I see that there is already some volatility which exceeds 10%, the low and the high. And I'm curious what causing the,
which asset?
For EURS.
Oh, again, since any asset in the DeFi world can have easily 10% volatility, because you have to understand some DeFi platforms price the asset relative to Ether. So what you have here on Uniswap, for example, EURS Ether pair, when Ether goes up or down, Uniswap continues to provide a quote on EURS in Ether terms. And Ether, say, went up this weekend, say 10%, 7%, whatever. So unless there is somebody who is very quickly arbitraging there, you can see that band of prices price fluctuations. So it's not kind of uncommon for other stable coins, and for other assets, it's even the band is even more wide. So just don't worry about it. You can always buy and sell EURS at close to par. You can buy it on STASIS sellback at par, and you can always sell at 0.1%, I think, max. So as for the secondary market volatility, it's present, but some of these peaks, they are not tradable, right? So it's not something that there was this particular price that you could have traded on significant volume. Usually it's just the fluctuations that the platforms are delivering relative to the other digital assets, which are moving on their own as well.
I see. And my second question is, I have gone through the report published by the European Central Bank about Libra, and from my understanding, the legal requirements of setting a euro stablecoin has been either getting a banking license in the European Union, or if you don't manage the collateral, the euro yourself as an institution, you might be able to get with the electronic payment service provider, something like that. And I'm curious if you have reviewed this report, and if you try to change the legal license that EuroStasis is holding now.
Yeah, very good question. Not only I read the report, I wrote some parts of it for ECB. We've been in contact with all major regulators and couple central banks for the last 4 years, 2 years before launching the product, and then 2 years consequent, advising them on this technology, on this asset, and on the way to regulate the space. So far, we've been self-regulating ourselves to the best extent available on the market, being the audit reports and the assets that are held with the licensed custodians. Currently, we are not required to have any other license, and it's non-existent. I was a big supporter of e-money 2.0 kind of concept, where which could allow the stablecoin business model. Currently, the payment institution license disallows the stablecoin business model. You will not be able to make any yield or on your reserves at all. So in that way, you cannot make sure you keep the same amount of assets back in the tokens. But we are in contact with the ECB. We contributed to their latest CBDC agenda, some thoughts and some materials around the space and how it can evolve. And I think it's maybe 3 to 5 years until there is some clear regulatory guidelines what is a stable coin in the European Union licensing terms and what license could be required. So far, we've got several entities. One is located in Malta. It's just the issuer. It submitted an exemption from the VFA license to MFSA, because we are not facing retail clients. We are not holding customer funds. We're just holding the assets back in the stable coin. We also had a Maltese entity which facilitated secondary market. It's ironically was called Glozo, but now I decided to shift it to Switzerland, because Switzerland has more favorable AML regulation and will allow better counterparties to join our board. and that market is operational. You can open up yourself an account at stasis.net/sellback, and there you will basically be onboarded by a Switzerland regulated entity. It's regulated by FINMA, and it's totally 100% licensed to conduct trading with retail and institutional corporate clients against their capital in our stable coin. So that's the way it works currently. But yeah, I have high hopes for Europe going forward, and maybe in 3, 4, 5 years, once the licensing regime becomes clear, we will be the first one to apply for it.
Thank you. Makes sense.
Excellent. Thanks a lot for that, Greg. That was really engaging, and we hope that we can interact more with you soon. So maybe some of our students will reach out a bit after.
Sure, please be my guest.
Excellent. Thanks a lot, Greg.
Yep, thank you. The questions were outstanding. I really like the audience. So thanks for having me, Joshua. I'll be staying. We'll stay in touch.
Definitely. Thanks a lot, Greg. Thanks, everyone.
Thank you. Thank you.
Thank
Greg.
you.